G'day viewers and welcome to the Motley Fool TV live stream. I'm Motley Fool Australia General Manager Adam Surplus. Joining me as always is the brains of tonight's stream, Chief Investment Officer Scott Phillips. G'day Scott.
We are all in trouble if that's true, Adam. G'day. Quick shout out too, by the way, if you're watching this later, we have a Chief Investment puppy at the Motley Fool. If you haven't seen the YouTube short of me having to deal with a dog while recording a video, I can highly recommend it just for sheer amusement. Plus he's pretty cute. So there you go. Bit of an ad. But yes, otherwise in my day job, I'm the Chief Investment Officer. Thank you.
That's right. I was going to ask about Diesel tonight. Scott, definitely my favourite Motley Fool employee this week. Haven't seen any invoices from him yet, but I'm expecting it. All right, onto the meat of tonight's show. Well, before we get to the meat, actually, please note that Motley Fool Australia is licensed to provide general investing advice only. We will answer all of your questions live, but they can't be specific to your situation. Having said that, put them into the YouTube live chat box anytime from now, and we will get to them as the show progresses. So, Scott, obviously the first thing, and how much of a difference 1 month can make. Only last month we were sitting here speculating on whether interest rate cuts would be this month or next month. Cuts looking like they're well and truly off the cards now. And I've got a question about this because we talked about this a long time ago. We should have known that the inflation numbers were coming. The jump in inflation, you know, from my sort of simplistic point of view, looks mostly related to the ending of energy rebates. You know, for retail energy users. We all knew this was coming. So should we have seen this coming a mile away?
Yeah, to some degree. The challenge was the increase in inflation was bigger than was expected because of that. So the energy rebates coming off added something like 0.1 or 0.2% to inflation. So yes, absolutely, we could have, should have, knew it was going to happen. It's been super messy because different states have had different programs at different times. Energy was up 23%. In the last quarter, right? So that's a massive, massive jump. Added to the household, so it's in the total, the housing category, and that was up, I think, 6% from memory. The problem is it was up across the board. Inflation was high for food, alcohol and tobacco, insurance, health, holidays, recreation. So we've got to, this is the real challenge. Across the board, inflation is high. Now, I will say, partly to your point, but also just to broaden that point out, energy goes into everything. So whether it's fuel or whether it's electricity, it is a cost that is in everything that we do, everything that we buy. And so it's kind of one of those input costs that, yes, we think about what we pay as consumers, and of course that's the one we care about most, the hip pocket. But think about every business you deal with that's having to either absorb or in most cases pass on their increased costs. And so you start to roll that one forward, and you really get a sense of why inflation is problematic across the board. The challenge is, you're right, we did see it coming. The increase in inflation was simply more than accounted for by just that. And that's why the Reserve was particularly, clear about what's going on. There was an 80% chance, according to the bond market, of a rate cut in November. Once the unemployment numbers came out, we might talk about those later, that 80% fell to 40% and then fell to zero. Once we got the inflation data, it was just simply too hot. And look, the RBA might have changed its mind. It might have said, well, okay, on balance, we care about both. Maybe we'll do something different. But no surprise, they simply said, nope, not doing it. They said in the minutes, there was no discussion of either an increase or a decrease. When you have that, it's very, very clear. Everyone turned up and said, so I guess we're holding? Yeah, we're holding. Okay, cool, good meeting. Let's go home. It wasn't quite like that, but that's effectively what happened. They also, by the way, just out of interest, show these days the voting. And it was a unanimous decision to keep interest rates on hold. So that was a November meeting. They're meeting again in December, as you say, and the market odds are almost exactly zero for that as well. Now, by the way, we say that the market odds were 80% of a rate cut for November, only a couple of weeks out. So that can change really quickly based on the data. I hope that almost kind of an extension of the question you're asking, the RBA wants to believe it's temporary. I suspect that's more wishful thinking than anything else. I think they're holding out hope like, well, maybe things get better, maybe they don't. We'll have to wait and see. The challenge is you ask yourself, why would they get better? And that's the real question. The economy is running pretty well. Paul Bloxham, the HSBC chief economist, wrote in the Fin, I think it was today or yesterday, saying that the Australian economy is going faster than its speed limit. And that comes out of productivity. We can talk about that if you want. But the broad idea is, if that's true, if we're growing faster than we can effectively supply, what does that mean? We're back in that demand supply imbalance. We're back in price increases, and you ask yourself, and the reserve, I suppose you don't want to increase rates, right? No one wants to do that for a million different reasons, including confidence, but also mortgage repayments. But if inflation is 3.2 and you're not going to put rates up, why would you expect it to come down? Now, it will eventually, but the real risk here is they won't. Speaking of HSBC, they're now forecasting no change to rates this year, no change to rates in 2026, and the next change in rates to be 2027, when rates might increase. That's their view. CBA has said no cuts on the horizon of their forecast. Other economists have done different things. And again, I say that, and again, fully in the knowledge that we've just talked about the fact that the market got it wrong, expecting a rate cut in November until we got so close that the bets were almost useless to make. But that is the state of the economy. That's the state of inflation. That's why there's so much uncertainty for homeowners, for anyone with debt, including companies, by the way, the companies that we own and cover. So yeah, there's a bit going on. For now, you just got to cross your fingers and hope, because it's not looking good unless we just get really super lucky and somehow inflation falls. It could be higher for longer.
Yeah, and obviously related to that, a couple of weeks ago, employment numbers came out showing unemployment rises, but also more jobs created. So how does that fit in with this picture?
So this is really weird. I mean, it's perfectly logical, and I'll explain it, but it's really, really unusual. When you see unemployment rise, I'm sure it's happened in my adult lifetime, but I can't remember the last time it did. When unemployment rises and we created more jobs, the thinking normally is, well, people lost their jobs, so the rate goes up. Makes perfect sense, right? This time, people got jobs. We created 13,000 jobs last month, and the unemployment rate still rose. Well, hang on, what's going on there? Now, it comes down to household formation, population growth, people looking for work. So the population is growing quite strongly. We know that. So the reality was there were 50,000 people who wanted a job, new people. Only 15 or 13,000 actually found one. And so that math is the problem. 3 times as many wanted a job as could get one, and that pushed the rate up. And it's a really strange one, because on one hand you say, well, the economy is strong enough to create jobs. That's a positive. We shouldn't fret about lost jobs, at least not just yet. On the flip side, you can't just ignore those people who wanted a job and couldn't get one and say, well, bad luck. The population grew. That's your fault, not mine. So there is a really difficult one here. It's also true, mate. This is controversial, but I think it's controversial among people who want to believe in their own ideology or their own preference and their own view of the world. The simple reality is we tried to believe that during COVID, when we had high inflation, when the economy was running at 110 to 113 to the dozen, we wanted to believe that somehow full employment meant 3 point something. And I would have loved that to be true. The reality is, when you're overheating an economy, yes, you're going to create more jobs, because that's exactly what it does. When you stop overheating the economy and you try and get inflation back under control, you're not going to have as many. It's just logic, right? And it's not comfortable. I don't like it. It's people say, oh, the RBA wants people out of work. No, they don't. The RBA has said, if labour market is too tight, that will add to price pressures. That's just the maths of it, right? It's they're not making a value judgment. They're not blaming anybody. They're saying, here's what happens. If we have strong labour market, we will have higher prices, almost certainly. Partly causal, partly because they're both correlated, because our stronger economy creates more jobs, more inflation, because it just does. Demand outstrips supply. That's what happens. Everyone who wants a job almost can get one, and it's a great thing to be in. This was never sustainable. And so we need to kind of get our heads back around that. It's super political, super ideological. You know me, mate, I don't really care for either of those two things. It's the pragmatics that matters. And this is just what happens when you have a situation where we're going back to not overheating the economy. Jobs go back to a not overheating economy level. So this thing called the NIRU, N-I-A-R-U, the non-accelerating inflation rate of unemployment. How's that for a mouthful? It's basically the level of employment at which inflation starts to rise. And again, we've just seen that, right? So, a lot of people wanted to believe X-Files style over the past 18 months. Unfortunately, it was not likely to be true. It's not true. We're going to have higher unemployment if we want lower inflation. We can choose the other, but remember, prices have gone up 25% or more in total over the past 5 years. That's everything you bought now costs a quarter more than they did in 2020. That's the pain of inflation. Rates go up and down. Inflation's effectively forever. So we're now paying a lot more for everything. We're still absorbing that, by the way. Real wages are still well behind where they were in 2020. So we're still worse off. More inflation would just make that worse for longer. And the RBA's got a devil of a job. They've got to say either, I'm happy to accept higher unemployment, or I'm happy to accept higher prices. It's just the devil's bargain, but they've got to make a stand.
Yeah, and household spending, still strong as well. Is that purely because the price of everything is higher? We're not buying more; we're just paying more for it.
Yeah, in part. So sales are up 5 point. Total household spending. We used to have a retail sales data. They've just rolled in a total household spending now, so that's what we get. So I'm still getting my mouth around that. Up 5.1% year on year, up 0.2% month on month. And yes, so let's say inflation is 3.2%. Effectively, 60% of the increase is price. Now the rest is still volume, and that probably ties in nicely with population growth. We're growing the population at 2 or 2.5%. So you kind of go inflation plus population. Guess what? You get to where you expect to get to. And again, that makes perfect sense, right? Real wages are flat-ish. They're probably up a little bit. And again, don't at me if you have a political view. I don't really care much about that. Love you all, but the rusted-ons don't thrill me. So yeah, the simple reality is we have more people and higher prices. It's no surprise that pushes retail spending, household spending up. It's a good time to talk about it, by the way, because later this month, well, I was going to say later this month, we have Black Friday sales. I don't know about you, but I've already got emails in my inbox from Black Friday, and you think, well, hang on, it's not only is it not Friday, we're about 2 weeks and a day away from actual Black Friday. So Black November, as we probably should call it now, has started in full throttle, and it's really hard to know because every November has grown year on year above the average yearly growth. Why? Because more of us taking advantage of the sales, and so we look at household spending and go, well, is that genuinely the underlying level of demand? Or is there some people putting off purchases and we'll again see a massive November? And then again, as I've said, probably on this program, I suspect in the past, you've now got to look at November and December's retail sales together because there's a lot being pushed out of October into November and a lot of November being pulled out of December. So you've kind of got this almost quarterly number you need to look at and say, what are we spending in total? Because that change in behavior is really, really important. I should add one thing too, mate. This is a bit of an aside, but speaking of things that are changing, both the ABS and the ATO have said they don't know how many illegal smokes we're smoking. And we know it's been a huge issue. It's a massive issue for the government budget, by the way. We can talk about that separately, but it's also a big issue for organised crime. And most directly, I suppose, it doesn't get counted in the numbers. So the ABS deliberately for now at least, don't count illicit tobacco sales. And so we're seeing Woolies and Coles, when they had their retail sales out recently, the Coles sales, tobacco sales were down 60% year on year. That's $3.05 in 12 months. Have deserted the store. Now we know where they're all going, right? I'd love to think people stop smoking, but we know that's not true. So ironically, inflation is actually lower than reported because the people who are smoking are spending less on smokes than they were this time last year. If there is a silver lining, I don't know the silver lining to smoking, but at least economically, we end up with a slightly better inflation number because the price of the average cigarette dropped because people are buying them from the local corner store, getting the under-the-counter stuff and saving a mozza.
Right. Well, speaking about wondering what people are smoking, you wrote about bank profits in Take Stock earlier this week. Macquarie's loan book grew by 22%. Do you want to elaborate more on what you mentioned in that email that went out?
Isn't that astonishing? By the way, since I did that, Westpac and NAB have reported profits. So I might start there and work backwards if that's okay.
Go for it.
Westpac's numbers were out yesterday. Their profits fell 1%. Now, still $6.9 billion, if you don't mind. No one's crying about Westpac's profits, but they're really struggling to grow. Today, NAB was out. Their underlying profit up 1%. Their reported profit down 2.9%. Here's the other thing about it. This is, speaking of inflation, this is where it's really, really important. I don't think we talked about Woolies last time. We may have. Their profits fell because they had modest sales growth, but their costs increased faster than sales. Now, in normal inflationary times, when it's much lower, it has been over the past 40 years, you kind of need to worry about it. But you really do this time around. So back to NAB, their deposits grew at 7.4%. You go, well, that's great. Their loan book grew at 5.9%. You think, well, fantastic. And yet profits went backwards. And you say, well, how did that happen? The answer is costs. They simply aren't growing fast enough to absorb all of the increased costs. And again, staff, electricity, insurance, rent, the whole box and dice, right? We're dealing with inflation as consumers. Businesses are as well. And if you can't get decent volume growth, sales growth, you're really going to hurt on the bottom line. And that's kind of the story. So really disappointing results. The NAB shares were down 3.3% today, I think, from memory. Shells just wanted more. Now, should they have expected more? Probably not, frankly. The bank's just really struggling to grow right now. So that's really important. With that asterisk, though, of Macquarie, as you mentioned. Now, this is fascinating. And I wrote about the power of incumbency that becomes a millstone around your neck really quickly if you're not careful. So when you're the incumbent, you build your castle, you build the walls, you dig the moat, you fill it with crocodiles and sewage and whatever else. Sorry if you're eating dinner. And you defend your castle, right? You say, well, this is what I'm making my stand. And that is great for such a long time. The problem is at some other point when you say, well, hang on, the fight's now over there, but I'm stuck in my castle here and I can't move it. What do I do? Now, the Singapore World War II guns story is a little bit apocryphal, but a little bit true. They're cemented facing the wrong direction, right? And that's part of the story. If you build yourself that business, or that strategy in this case, and all of a sudden you have an attack from a different direction, what do? You've got nowhere to go because you've built a business on doing a certain thing. Now, the banks are spectacularly dominant. We just talked about those two banks I mentioned, $14 billion in total from two of the big four. So they're fine. They're doing completely okay. But what are they? They're big. They're cumbersome. Their IT systems are, in some cases, 30, 40, 50 years old, held together with string and sticky tape. Their cultures are, in some cases, wonderful, in some cases, awful. They've got branch networks they desperately don't want. Don't at me about cash or branch service. The banks don't want to provide the branches. They do it because we would complain and the pollies would whinge, and they just can't deal with the PR. So they're just going to keep them open, right? I'm sure if you let the banks do it, so that your 12-month amnesty, close whatever you want, they'll probably close 50% of branches, maybe even more than that, frankly, I suspect. So you've got all this stuff, right? Those are great and dominant features to have until they become millstones, until the calcification of those businesses go from incumbent, strong, stable, well-known, great reputation. Bank customers are stupidly loyal, and I say stupidly kind of literally and metaphorically, right? The loyalty we show away banks when they're giving us a dud deal is mind-blowing to me. We always should get a better rate. I bang on about that, Adam. So that's kind of what's happening in the banks. They've gone from these wonderful business, see off all comers. And then Macquarie has done, just to mix my metaphors, Macquarie's done an Aldi to the bank's Woolies and Coles. Macquarie said, well, you guys are doing that. You're the full service bank with the branches, the staff, the people, God knows how many products, systems all over the shop, staffing, union issues. You're dealing with all that stuff. And again, no judgment, just that's what's going on over there. Macquarie's like, so what are we going to do? We're going to start or at least update a retail bank at Macquarie. We're going to build or refresh a tech stack, which is relatively new, relatively simple, relatively easy to do. And again, relative is important here. It's very complex, but you're not dealing with the decades of string and sticky tape at the big four. You then say, well, what we're going to do is we're going to only have online services. Now, I got to say, I'm not going to defend the banks too hard because I don't really care either way. But when the public says to the banks, big banks, you must keep your branches open, but Macquarie doesn't have to, that's a really nice advantage, right? They know they can get customers through digital networks or through the phone and get people to sign up for a Macquarie account. They've got none of those costs, none of the rent, none of the staff, none of the electricity, all that stuff it doesn't exist. And then you say, well, we're going to offer just a few products. Again, the Aldi analogy here, right? Tomato sauce, here's the tomato sauce. You want another one? Go to Woolies. If you want to get it cheap, come to us. And again, small size, small footprint, a few products. And then Macquarie's done even better. And they said, well, we're only going to try and chase really, really, really good credit risks. Why? Because they're not like a default. If they don't default, you give them a lower rate. And if you're not, Commonwealth Bank's got everything from the best risk in the business to the worst risk in the business, roughly. I mean to be critical here. I'm sure there's worse risks that don't get banked at all. But you know what I'm saying? The breadth of their risk is much, much bigger. Macquarie's just said, we just want the top stuff. Thanks very much. And what does that mean? It means if you do qualify, you're getting a better rate because you're not cross-subsidizing the bad risks in the rest of the bank. And so it's a really, really, really beautiful model. Now, yes, the neobanks, the new banks have tried it before. The regional banks have tried. Macquarie's Macquarie, right? So it's got the culture, it's got the people, it's got the cash. And it's just doing an extraordinarily good job. Macquarie's loan book is up 22%, as we said, and off a low-ish base. But from memory, it's a quarter of the ANZ loan book. Now, only a quarter, and there's four big banks, so you're a quarter of one of the four. You're not troubling the scores anytime soon. But think about the growth Macquarie's getting that the big banks can't find, and all of a sudden you've got Macquarie just pac-manning market share, just munching and munching and munching and munching. Why? Because it can. It's doing a better job with better service. Apparently, for all reports, the app is great. They're great to deal with, really simple and easy. Brokers like them because they're easy to put through. And so you've just built a better product, or a better condensed product suite. Just doing what you want to do, just the way you want to do it, just with the infrastructure and the resources you want to apply to it. And that's where, for the big banks, you've got to see off all the other challenges for decades. Now all of a sudden they're like, well, hang on, how do we fight with that? We've tried with our own digital banks, but we're kind of big banks and we don't really get that very well. And it's out there, but who knows what's going on really there. All the effort and energy and money is being spent over here. Macquarie's just gone, I'm going to design a product that works. I'm going to find a niche in the market and I'm going to exploit that niche for all it's worth. And I say exploit in a positive sense, by the way, not a negative one. And that's where we are. So yeah, I really, really impressive. I don't own shares in Macquarie. I don't own shares in the big banks. I got no dog in the fight, other than you see very, very clearly big banks struggling to grow and Macquarie just make money hand over fist. And it's just a reminder as an investor. So let's bring it back to investing, right? As owners of companies, we are all if hopefully you're a shareholder or an investor, you're a part owner of a company. And when you part own those shares, you look at the business and say, how do I feel about it? Now, I love dominant businesses, right? Because they're generally more profitable. They're generally more immune to downturns. They've generally got more scale, better balance sheets, all that sort of stuff, until they don't. And so be really, really, really careful of that. Not every innovator is going to win either. I've just mentioned the fact that the big guys sent off almost every challenger who tried. I mean, they bought Rams, they bought Wizard, they bought Bank West. Speaking of Pac-Man, they just absolutely made hay. But if Macquarie can continue to do this one, this will be the exception that proves the rule. And that's kind of, for an investor, a really, really important one here. Yes, love dominant businesses, but make sure that dominance is continuing to be prosecuted. By all means, love innovators and make sure you got evidence that it's happening. But Macquarie is showing everyone how it's done. Whether you're in finance, we're looking at retail, whether you're looking at tech, whatever you're looking at, just keep those two kind of opposite ideas in your head at the same time. I want dominant businesses, but I'll be really careful if I do. Great Jeff Bezos line from Amazon. I'm a shareholder. Your margin is my opportunity. That's exactly what Macquarie did. They said, hey, I'll have that. Thank you very much. And they've done a spectacular job doing it.
Yeah, it's really interesting that you mentioned, as you know, Commonwealth Bank launched its unloan product to compete with mortgages. And I actually refinanced a mortgage and joined up. And to my continued surprise, it's actually a really good service. It's a really good app. It was really easy, but it's owned by the Commonwealth Bank, and I keep waiting for the penny to drop. And and I think that's the problem. Like, it doesn't matter how good they make this product. They've just got this ball and chain around their neck that you know that it's Commonwealth Bank. I'm waiting any month now to get a letter with a Commonwealth Bank logo saying, "Yep, your unloan account has now been absorbed into the the Commonwealth Bank system, and your interest rate's going up 4.5%." And that's the problem that they're dealing with. So interesting that Macquarie's managed to do what they've done.
There's an interesting point too, mate. I took the Amazon story, right? And famously, and I'm an Amazon shareholder, so I like the story, but it's a really good story. When Amazon started up, they were a bookseller. They started selling some more stuff, and then at some point, someone said, "Hey, ebooks could be a thing." And most businesses would be like, "Well, we're a bookseller, so we don't like ebooks. We don't want to. We want to do everything we can to not have ebooks take our business." Jeff Bezos did the opposite. He took a team and said, "Right, you guys go." They're based in Seattle, in Washington State, Amazon, and he said to a team, "You guys go. But go over to the East Coast, go right away from here and build me an ebook business," knowing full well that it would cannibalize his current book business, but doing it because he knew that's where the customer was going. Your point on unloan is a great one, mate, because at the end of the day, someone's sitting at CBA going, well, hang on, if I have my really profitable customers go from CBA to this unloan thing, unless I can really make it work and scale, I risk losing some money here. And that's the your margin is my opportunity thing, because the big banks are saying, well, hang on, I don't want to drop my margins to compete with Macquarie, because if I do, I'm going to make less money. Now, I think they should, because you want to compete. There's no point. Your profit margins don't matter if there's no volume, right? Now, the banks aren't going to go anywhere anytime soon. But if you say, well, I'm going to protect my margins at all costs, what do? You bleed volume. And that can be sensible, because if you're bleeding unprofitable volume, that's fine. But all of a sudden you look around a couple of years' time and go, we thought we were protecting ourselves here. Turns out these high margins on low volumes are actually worse than if we just actually bit the bullet and gone, hey, shareholders, this sucks, but we're going to drop our prices by whatever the rate needs to be to make sure we are the most competitive bank in the country, because we've got this lead and we're not giving it up come hell or high water. That's what I would be doing if I was one of the big four banks. But the shareholders don't want it. They want their dividends. They want their stable profits. No one wants to say our profits down. So the bank CEOs are trying desperately to walk this tightrope between letting Macquarie steal their lunch and having less margin now. The problem if you do that is you're going to get caught in the middle, and that's really problematic. So again, hopefully they get unloan right. I mean, CBA is great on tech. To be fair to them, NetBank was a market leading product, CommSec, market leading in terms of their not cutting edge tech, but they used tech well to serve customers, and that's been great. Now other banks have caught up. I hope CBA, for their shareholders' sake, get unloan right. But yeah, it's a massive change to the business. And as you rightly point out, they're still part of the same thing. The other example is probably Jetstar and Qantas. Alan Joyce, love him or hate him, and most people don't love him. Jetstar, this you do your thing. Yeah, build us an airline, and they did it really, really nicely. I love a two-brand strategy if you get it right, but you've got to let the second brand do its thing. And to your point, mate, yeah, I would absolutely expect the same thing, in the same way that Westpac bought Rams, who bought Wizard? Can't remember now. Combank bought Bank West. By the way, ANZ bought Suncorp Bank. they'll roll those customers over at some point. Why? Because it's just easier to do it that way. And that's kind of the challenge, right? So you think you're doing something different. The boffins, the bean counters get involved. By the way, we love bean counters, right? We love making money. But if you get that wrong, if you prioritize short-term profits over long-term value, you are really, really in trouble.
Yeah, you need beans to count. Okay,
Yes.
let's move on to let's move on to a question about Australia's favourite soap opera IT company, WiseTech. A question from Tim. Can you please share your thoughts on WiseTech? A quality business with a strong moat, interesting leadership. I added that in. Recurring revenue and customer stickiness and questionable ethics of management. On a huge multiple, even after a 50% correction. What do you think, Scott?
It's a really, really good business. And so what I love about WiseTech, I don't own the shares. I haven't recommended the shares. It has been recommended by some of our services. So there's a free buy recommendation. They have, what I love is a company that can aggregate a very, very disparate category, because you can grow for years if you get that right. And freight forwarding is the most boring thing in the world, except if you're in it. You're dealing with a whole lot of paper and different systems and customs agents and all that sort of stuff. If you can solve that problem for people, you are going to make a fortune. That's exactly what WiseTech did. Richard White has built a business, built a product, built a company to solve that problem. And it's just, by the way, it's a great example of kind of capitalism done well, right? Capitalism, capital C, capitalism gets a lot of grief from a lot of people. But this is, hey, there's a problem. I'm going to create a company to fix that problem. And if I fix it for you and it's worth it, you'll join up and you'll sign up and you'll stay with me. And it's just beautiful. It's exactly what you want. We talk about productivity all the time. That's that in a nutshell, right? Someone's invented a product, a service, a system, a company to fix the productivity problem in freight forwarding. So it's really, really cool. That's the company. Now, you're right. There's been a lot of, soap opera is the right word, Adam, a lot of reporting about what WiseTech management may or may not have done in their private lives and their business lives. Share trades are most recently in the news. Apparently, ASIC sniffing around to see if there's any improper trading going on. We should say allegedly a few times here, just to make sure we're very clear with people. The question and WiseTech's hard, because normally I would say there's the business and there's the soap opera. Super Retail, I own shares in. The CEO was punted recently because the board said that he hadn't disclosed everything when there were some questions being asked. And apparently there was subsequent news came to light and the board said, right, well, you're out of here. In that case, excuse me, the CEO was important, but the Super Retail brands, Super Cheap Auto, Rebel, Macpac, BCF, they're not going to be, I'm not buying less camping gear from BCF because the CEO was allegedly or not allegedly doing something that maybe shouldn't have been done. It doesn't matter. Who cares? And the businesses themselves aren't going to change. It's not like BCF's going to sell different products, whether he's there or not. Now, I should say there are some great retailers who absolutely are worth their weight in gold. And I don't mean to criticize at all the outgoing CEO for being bad at his job. He's not. He was perfectly fine. I just don't think, and with all due respect, he was that consequential. Richard White is a different story. He built the business. This is, I think we talked before about key person risk, right? We love founder CEOs, but when things go bad from that perspective, Chris Ellison at Mineral Resources has had some equally uncomfortable reporting done about his activities. And again, no wrongdoing asserted or alleged here, but that stuff you have to think, well, hang on, how important are they to the company? And by the way, so the Richard White saga, the first time around, the board effectively punted him. And then he got shareholders together and said, I'm coming back. Thank you very much. You guys go. And that's what happened. Shareholders decided they were happy to overlook the reported, alleged, whatever Richard White was up to and say, well, for all of that, you're really valuable. You're worth more to us at the company, even despite that. So can you please come and do your thing? Now, that's before this most recent investigation. We don't know what happens here. What we don't know, and I'll say just outright, we don't know, is how important Richard White's attendance, appearance, involvement is for WiseTech's future growth. At some point, it matters. Let's take Apple, for example. Steve Jobs for the 80s and 90s was the dude, right? 2000s as well, frankly. If Jobs isn't there, Apple goes broke almost certainly. At best, they're selling Macs in colored Perspex cases, right? The iPhone, the iPod originally, the iPhone, the stuff that comes after that is all pure Jobs. But at a point, he could hand over to Tim Cook, who's done a spectacular job, despite effectively being a supply chain guy. I mean, I don't mean to denigrate Cook. He's a great guy, but he's not the creative genius that Jobs was. And they've been able to continue to build and grow that business over time because at the right point, you didn't need the jobs reality distortion field, as they call it. You just said, okay, we've got a business, we've got a model, we've got products, we've got customers, we've got good people, we know where we're going, we've got a culture and a strategy, let's go. And you just want someone at the top who can prosecute that, really successfully. So what we don't know outright is how important is Richard White and where are they at this time in this particular part of the business. Now, shareholders, when the shares were sold off recently, absolutely scared that there might well be Richard White being maybe banned from being involved in the company as an executive or as a director. And investors are saying, well, hang on, we actually don't think that's okay, or at least we think that the business is worth less without him than with him, even despite those things that he may or may not have done, or, again, allegedly. So it's a really difficult one. And that's the question for any shareholder at any point is, how important is the key person? David Dicker at Dicker Data was effectively forced off the board. So there have been, that was reported in the Australian, there have been plenty of those examples. The question for us is, where are they at? I suspect WiseTech is big enough, with enough momentum, enough work in progress to probably continue to do well. Because what Richard White has built is a system that is aggregating customers, aggregating other providers, building an ecosystem. And if you do that, the ecosystem kind of stands for itself. So it's not particularly cheap. You've got to believe it's going to grow pretty strongly for a while, and you kind of made that point. Tim, I think it was. So I haven't recommended it for my members. Some other teams have. So it takes a market. But the company is really, really impressive. The product's impressive. They've done a wonderful job of finding that opportunity to aggregate a really disparate category. I suspect they'll keep doing it. Will they do it fast enough to justify the valuation? I don't know. That's not a weasel way of saying no. I genuinely don't know. I don't have a sufficiently informed view. What I would say is this will test your mettle as an investor. Do you want to be involved while there's no certainty, or do you want to wait until after we know what happens next and then make your judgment? There's no harm in either of those strategies as long as you know what you're doing. If you want to wait, that's fine. You might lose a 10, 15, 20% upside if the shares get better before the news comes out. On the flip side, you might jump in now, and then White is barred from being a director for 5 years, and whatever else happens, and the shares fall another 20%. So I don't know what happens in the short term. I do think the company is probably in a pretty good position for the long term.
Yeah, it's one of those exciting holdings, I'm sure. I don't own WiseTech myself. I have in
Exciting
the past.
Is one of those, yeah.
Some of them are more fun. And yes, obviously, Tim, to answer your other question or respond to your other comment, we are real. We're not AI. Any AI content that produces this as a result has got some more work to do. All right, moving on. We have a question. This is right up your alley, Scott. Question from Jake. Can you please talk about Treasury Wine Estates in regards to the last not good update about slower growth? That's a euphemism, I think. What's your view on the long-term regards China growth?
I'm a shareholder. I've recommended it. We recommended it again relatively recently for Share Advisor members. There's another free recommendation. The market hates it. Absolutely hates it. I thought it was cheap at 9. I thought it was cheap at 7. I thought it was cheap at 6. I don't know where the share price is now. I can have a look in a minute. Sentiment in the short term is going to take you wherever it wants to take you. What you have to do is divorce your assessment of value from what the market is saying. Mr. Market's right a lot. Our job as investors, frankly, my day job, but anyone's job if you're an investor, is to work out when Mr. Market's wrong. Because if Mr. Market's right, the shares are fairly valued and you get a market average return. That's perfectly fine, but you can do that with an ETF. What we're trying to do is say, where do we think Mr. Market is overly pessimistic when it comes to buying shares? And when we're selling, we're saying, where's Mr. Market overly optimistic? Where are we offering too good a price to refuse? And that's kind of the job of the stock picker. So I look at Treasury Wine Estates, and I think it's a fascinating business, and I can't really do it justice without the images, but there's 3 parts of the business. There's the Penfolds brand, there's Treasury Americas, I think it's still called that, and they used to call it Treasury Premium Brands, which was a massive misnomer. It was rubbish that they couldn't sell at a higher price. I think it's called Treasury Collective now from memory. They've renamed it because it just was a bit silly. The Treasury, that business is awful. Making wine in Australia is a terrible, terrible, terrible business. I think I've used this example before, Adam, and if I have, my apologies to everyone who's seen this before. Canunga Hill, Penfolds Canunga Hill Shiraz Cabernet was a wine I used to sell when I worked at a grog shop when I was 18. I reckon the price is probably almost entirely unchanged in the long years since then. Why? Because it's just a commodity product. Why? That kind of 10, 15, 20 buck wine in Australia is just an absolute commodity. There is no pricing power anywhere. So that's an awful business. They tried to sell it. No one wants to buy it, right? It tells you everything you need to know. The Americas business is doing pretty well. And the Penfolds brand is an absolutely stonkingly great business. They make profit margins. They call it EBITs. I won't go into the boring acronym. It's earnings before interest, tax, self-generating and regenerating assets. There you go. You're welcome. I want to say it's 50%. It's stupidly high. Whatever the number is, like, it's just way, way, way high. Because you've got massive pricing power, right? Limited supply, only the best stuff. They put the price up whenever they can. It is a brilliant business. So that's why I like Treasury Wine Estates. As the rubbish business gets smaller, and it is, Penfolds gets larger both in absolute terms and as a proportion. So in the past, you were kind of buying Penfolds and Americas and Collective. You're now pretty much buying Penfolds, a little bit of Americas. Collective is pretty much just break even. So it's not impacting the profit anymore. And so you've got this real juggernaut business. Now, in the short term, apparently Chinese demand has slowed. And the question really is unanswerable other than speculation, estimation, and guesstimation, hopefully intelligently, which is, will that recover? Now, my view is that the Penfolds business in Australia is a cash cow business. If you're buying a bottle of Grange, good luck to you. You got more money than I've got, and I don't begrudge you it at all because I'd love to be buying some. So, you know, and that'll go for $1,000 a bottle now, whatever it is. It's stupid high. And we just, people can keep doing it, right? It's cash cow business. You just keep the prices high, keep the volume restricted, and sell it to people who just love the hell out of their wines. China long term, unless there is a massive change in the consumption patterns for alcohol in China, and it might happen. By all reports, the Chinese Communist Party said less banquets is apparently, you know, Chinese Communist Party is pretty powerful. Fewer banquets, less wine served. This is top-end wine, so it's probably going to be served with the Chinese Communist Party throwing money around. The average peasant in China, unfortunately, can't afford Penfolds. So that's kind of a short-term issue. So the question for us is it going to continue? Are we going to have them effectively step away from wine, generally, and Penfolds in particular, permanently, or for, at least for the medium to long term? Or are they going to come back? I don't know the answer, but I would suspect that it doesn't take long to come back. I also suspect that even if it does take a while, because they're high priced, because they're limited volumes, yes, there might be some short-term dramas, but there's a really nice dividend yield at the moment. It may come down because they've suspended the share buyback and they're kind of, you know, counting their pennies. But I think it's a really high-class business. It's a cash cow business. The brand is spectacularly good. It's not going anywhere anytime soon. More Chinese are becoming more affluent every year. That's a growing market for them. Again, is it perfect? No. Is it a guarantee? Absolutely not. Please hear me say, I own the shares not because I believe that I can perfectly see the future, because I believe the risk reward is attractive enough to buy. So I like Treasury. I think it'll do well over the medium and long term. Sentiment's against it. The downgrade's not a removal of guidance. Not welcome. Shares are going to fall on that basis, and fair enough too, honestly. You say I'm going to do X, you say I'm not going to do that anymore. The market's inclined to go, well, I guess that's less then, so it's worth less. Kind of makes some sense. Long term, I don't suspect it changes the thesis. And if the price is cheaper, that's the Mr. Market pessimism stuff we can take advantage of if we're right.
Very good. Okay, I think I know the answer to this one, but I'm going to ask it anyway. G'day, guys. Any thoughts on margin loans for retail investors?
Man, so many thoughts. None of them good. Please don't
one, really.
use margin. Yes, well, that's right. That's right. I say it many times if you want me to. Please don't use margin. Please don't use margin. Please don't use margin. Here's the thing. Margin, obligatory Warren Buffett quote, leverage is the only way a smart guy can go broke. Now, we should say guys and girls or people these days, but Buffett said, leverage is the only way a smart guy can go broke. In other words, if you don't borrow money, you can't go broke. If you're even half that, you can't go broke. Now, can you magnify your upside? Absolutely. Do you risk magnifying your downside? Absolutely. Not only that, you have margin calls. So that your broker or your financier can force you to sell your shares if the value falls far enough. Without consulting you, you've probably got a trading day to find some cash. If you can't find it, they're going to sell the shares out from under you. And when are they going to do that? When the market's down, because that's when you get a margin call. So a margin call is when you borrow some money. Let's pick some numbers. You got $100 worth of shares, you borrow $70. You got a loan to valuation ratio of 70%. Is that pretty clear? If the shares fall to $90, I can't do the math, 7 ninths, 77.7%. If your margin call is 75, the shares fall 10%, not much. All of a sudden, the bank's saying, well, we're going to sell some of your shares to get your loan to valuation ratio back under 75%. So you're selling when the price is down. Now, you know, buy low, sell high, or sell never, whichever you prefer, but don't buy high, sell low, or don't buy low, sell low, because you're forced to by the bank. The other thing about margin loans is everybody thinks they will use them well, and some people do. The problem is 90% of us think we're above average drivers, right? That's just the human condition. So I think I'll use margin well. Adam thinks he'll use margin well. Everyone watching thinks they'll use margin well. Someone's not going to. Maybe you're unlucky. Maybe you don't know what you're doing. Maybe temperamentally you just get scared out of things. You see it falling, you go, oh, I'm out, I'm just selling everything. Closing the loan, I'm done. That's a really quick way to lose all of your equity because you borrowed the difference, right? You got to pay that back. So as the share prices fall, you're only losing equity. You got to pay the whole loan back. The loan value doesn't fall. So yeah, please don't use margin. Here's the other thing: you don't need to use margin. I mean, if you're throwing Hail Mary pass at 64 with margin, I mean, please don't. This is the other Buffett quote. Talked about people risking what they have and need for what they didn't have and didn't need. Now, I say need specifically. Would I like more money? Of course. Would I like a larger portfolio? Of course. Do I want to gamble what I've got, risk going back to zero to get a little bit of upside? Hell no. So please don't use margin. Please don't use margin. Please don't use margin. Again, some people will use it well, and they'll say, I can use it well. I'm smart enough. I'm capable enough. I've got the right temperament. Maybe you do, but maybe you don't. And you really don't want to find that out at the worst possible moment with a margin call, or where you just get freaked out like, oh, I mean, imagine during COVID, right? Market fell 38% in a month and 4 days. Now, almost any level of margin gets wiped. I mean, if you've got 10% margin, maybe you're okay. 20%, you're probably okay. If you're using margin, you're probably using it in a larger amount of money. Most people got margin called or wiped out because they just had to sell everything. And all of a sudden, your equity goes to zero, and then the market rebounds. And what are you doing? You're watching from the sidelines. And again, you say, well, that wouldn't be me. I wouldn't do that. Maybe not, right? And I get it. So this is not a criticism of anybody. It is a reminder that everyone who thinks they'll use it well, not everyone who thinks they'll use it well does use it well. They catch themselves out in whatever reason, whatever unfortunate, unexpected circumstances. It just happens sometimes. And you just don't want to start from scratch. You don't want to go back to square one. So please don't use it. Slow and steady wins the race. Be the tortoise, not the hare. There you go. Bit of Aesop, bit of Warren Buffett. Please don't. By the way, the other thing is the margin loan rates are astonishing right now. They're really high. So not only do you risk a margin call, you've got to beat the margin loan interest rate, right? And again, maybe you think you're the world's best investor, maybe you can beat the rate, maybe you can. But even if you don't get wiped out, if you're paying 9%, you're earning 8%, you're going backwards at 1% a year. So yeah, just be, well, I was going to say be careful. Don't be careful. Just don't do it, please. Not personal advice, general advice. Don't use margin, please.
Yeah, it's an expensive way to buy a whole lot of risk, isn't it? All
Yeah,
right,
exactly.
we have another question. Yeah. Hi again, what is PEG? I don't know if we call this PEG ratio or PEG, price earnings to growth ratio, and how can it help us find the right stocks?
I'm not sure it can. And it was relatively popular during the 90s. And yes, I'm talking about the go-go years, the dot-com boom. The PEG ratio, the price earnings to growth ratio, you take the price to earnings ratio and you divide it into the growth that the company's achieving. And if the growth is higher than the price earnings ratio, then in theory, it's supposed to be a buy signal. Why do I hesitate? It's really hard to find these days. It's hard to find a company growing faster than its price earnings ratio. Even then, what are you growing? Is it profit? Is it sales? Is it something else that's growing faster? Will it continue to grow faster? How long will it grow for? It's a nice heuristic. And I guess if you wanted to use it to screen for companies that are at the top end of that group, if you just sort of said, okay, well, I'll look for the PEG ratio on every company in the ASX for fun, right? And you find the ones with the best PEG ratio, you might say, well, I'll start there and see if I can find some value. So I wouldn't rule it out as a screening tool. Called screening tool, basically a filtering tool, right? Finding some opportunities. There may be some opportunities using the PEG ratio to find some companies that might be worth further investigation. So you're asking how you'd use it. That's how I would use it. If I was going to, I'd be saying, right, what's the PE? What's the growth? If you get a good number there, you're probably in a pretty good place, at least as a starting point for more research. So by all means do that. The only challenge with that is you end up buying momentum stocks. And momentum stocks are ones, call them story stocks, call them go-go stocks, call them what you want. They're the ones that everyone's already excited about. And so you do kind of run the risk of jumping on the same bandwagon as everybody else. And if the bandwagon crashes, stops, falls over, loses a wheel, then you're kind of stuck in the same thing. And again, it's not to say it's bad to do, but often you're looking at the same companies everyone else is looking at. The chance of them being mispriced when they're that popular, actually pretty high, but high on the upside. In other words, you're maybe going to pay too much for it. Because everyone's like, oh, the growth's amazing, the growth forever, let's do it. Now, the price earnings ratio should help you by mitigating for that. And that's definitely something you can look at, absolutely. The other way to look at this as a one I probably prefer as a screening tool, as a filtering tool, is the magic formula. I think it's Joel Greenblatt. He looks at price earnings and return on equity and uses those as opportunities to kind of find price earnings gives you value, return on equity gives you, in theory, quality. It's not perfect. Again, I wouldn't use it. I haven't used it to pick stocks. but it's a great way to think about where am I getting high quality at a relatively inexpensive price. Last thing for me on this one is they are retrospective. They are backwards looking. And so you're going to miss the company that has one bad year of earnings for whatever reason, good or bad. You're going to miss the company that isn't profitable yet. You're going to miss the company that, for whatever reason, the price, you might have a business that, for example, looks like it's on a low PE, but that's because the market already expects that next year's profit is going to be really low. So price earnings to growth, if you're looking backwards, so well, hang on, I'm buying this thing at a really cheap price. Maybe it's a miner and the iron ore price has fallen through the floor. Maybe it's a tech business that sold off half its assets to somebody else. The devil's always in the detail. That's why I don't use mechanical screening tools like these as a stock picking mechanism, but you absolutely can use those with the magic formula, PEG ratio. You can use those to identify a list that are worth looking more into. That's how I would use it.
All righty, now let's go to the US. And every time US markets are at all-time highs, we can expect a tweet from Michael Burry, famous bear in the US. Yeah. They made a movie about him. It was a whole thing. But this time, he's put his money where his mouth is. Yeah. He's done this before. Basically, he's shorting $1.5 billion in big tech. That's a big gamble, and obvious. The very next day he seems to have come good. He's off to a flying start because the US market dumped a couple of percentage points on day one after he's done this. Yep. Is this an economic indicator that we should take seriously?
Take it seriously, yes. Extrapolate from it, no. So Michael Burry, famously, The Big Short was the movie. He was the guy, one of the guys, but the kind of highest profile guy who found or realized, recognized, believed, assumed, guessed that the subprime crisis was a crisis. And he's probably one of the 3 or 4 people in the entire United States who read all of the documentation on all of these residential mortgage-backed securities, RMBSs or CDOs, collateralized debt obligations. Yes, it already sounds boring, right? He literally sat down and went through hundreds of pages of all these things and kind of just went, hang on, this is crazy. This can't go well. We have too much. The AAA credit ratings don't, the idea that somehow one house in California, one in Denver, and one in New York would be completely opposite markets that simply would move in different directions. He's like, well, interest rates are national and economic growth is national to most extent. And if this does go badly, then the whole thing comes down like a house of cards. It's exactly what happened. So he's very, very well known for that. A really good call. Funny little aside, by the way, his investors hated him. So he had this bet on for about 2 years, 18 months, 2 years before the collapse actually happened. And when you go short, you borrow the shares and you pay to borrow those shares so you can sell them short and then buy them back later at a lower price. That's the idea. That's what you're trying to do. Now, he was shorting not shares, but something else. But for all intents and purposes, that's what it is. It's what he's doing with tech, right? So that's what you do. But you got to pay to borrow them. And so for 2 years, 2 things were happening. He was paying this interest on the borrow, and the price was going up, not down. And the investors are like, Burry, you're an idiot. Give me my money back. And Michael, God love him, he running a fund, and the fund rules allowed him to say, no, I'm not giving you your money back. I'm keeping it. And he had hate mail and all sorts of just awful, awful things. And Burry's like, nope, I know what I'm doing. I'm going to be right. You're just going to have to wait. Now, that's both incredibly hubristic and also completely right, as it turns out. Could have gone very, very badly, and they could have done their dough. Burry was right in this instance. So that's why he gets that cachet. People like Dr. Doom, Nouri Albini, picked one crash, and so everyone quotes him every time he makes a prognostication. And that's why I said take it seriously, but don't extrapolate. Burry's made other calls since, and he's been wrong. So he always gets the headline when he makes a call because he was the Big Short guy, and so that gets you the headlines, it gets you the clicks, it gets you the column inches, and fair enough, he's entitled to it. But if you think about what he's actually doing, it's hard to follow. The other reason not to extrapolate too closely is we don't know the rationale of the short. And yes, the idea is you make money if it goes down. So that's what he's betting on, right? But is he saying that these companies are literally overvalued based on a long-term basis? Maybe. Is he saying everyone's so excited about these, I think there's going to be a short-term blip and a crash because optimism is going to go away and I'm going to make some money in 3 months? Maybe. But knowing which one of those is which is really important. Because if you're a long-term investor, if you're trying to make a 3-month gain, but he thinks the long term is attractive, I mean, you can try and shadow trade Michael Burry. You can say, well, I'm in it for the long term anyway, so I'm not playing that game. And so it does risk scaring you out of the market. Now, I will say, this is going to be live, or this live on YouTube, and it'll be available. The internet's forever, right? So at some point we'll know the answer. Did he get it right? Did he get it wrong? I don't know. What's fascinating about the US right now is US tech stocks are really expensive on. Sorry, I'll start that again. The US market is really expensive because the US tech stocks are higher PEs, which is about the PEG ratio, higher PEs than traditionally have been the case for large companies. Go back 10, 15, 20 years, maybe 20, 25. What were the biggest companies? We had ExxonMobil, an oil company, with massive amounts of capital investment growing at a couple of percent a year. General Motors, General Electric, whatever else there were, those sort of big businesses, they were big, slow, slumbering giants. Now, if you're the largest in the business and you have a low PE, the average PE of the market is low. Fast forward to 2025, and you've got the so-called Magnificent Seven with really high PEs, or at least higher PEs than these other big behemoths of the past. And they are enormous. They are so dominant now in the US. They overshadow everything. So where they go, goes the market. So on one hand, you say, well, that feels risky. The PEs are really high. The other thing is these guys are growing at, in most cases, mid-teen growth rates. And so you've got to really, this is not your grandfather's market, right? You've got a very different market than we used to have. This is not the big blue chip, slow growing, capital intensive behemoth companies employing tens of thousands of Americans that we had in the 80s and 90s. This is the .com growers inventing the future. Quite literally, I know I use that line a lot, but it's so true. Think about AI, think about search, think about social networking, think about streaming, pick your topic, right? Computer chips, NVIDIA. I don't own those shares and I don't have a strong view on their value, but overall, it's a very reasonable argument to make that the US market looks overvalued because it's higher on a P base than it's almost ever been, but we've never had the biggest 7 companies growing at those sort of rates. And so it's really important that you don't just look backwards. Another Buffett line, I think I'm up to about 4 or 5. If history was all there was to investing, the richest people would be librarians, right? If you just look back and said, well, okay, I'll extrapolate that forward, then I'm good. So maybe the market crashes 20%, maybe it goes up 20%, maybe it goes sideways. I don't know. Don't fall for the fear stuff. It's so pervasive. We can't help it. We're human. We feel the pain of loss 3 times of the joy of an equivalent gain, right? We're just humans. It's what we do. And so that's not, I'm not going to tell you how to suck eggs, but I'm going to say, just recognize that about yourself. Can they fall? Yes. Will they fall? I don't know. So Barry's made a bet. He's been wrong before. He's been right before. Is he right this time? No one knows. Also, though, if you're a long-term investor, it's a different story. He's shorting a market with a carry, a cost that he needs to close at some point. Maybe it happens. Maybe he makes some money. Maybe he doesn't. No particular view other than I'm not playing that game. I'm not shorting the market. Morgan Housel, great author, former Motley Fool employee, got a great line. More money is lost preparing for the next crash than in the next crash. And he means not money losses in values of portfolios falling, but the missed opportunity to grow in the meantime. If the market doubles, then falls by 20%, well, guess what? You're better off being on that journey than saying the market might fall 20% in 2 years' time. I better wait. And you miss the growth in the meantime. So no strong view on US valuations. I own some of those companies. I own Amazon shares. I've already mentioned that a couple of times. I own shares in Berkshire. They own Apple shares. So, I'm partly invested in that. They're not screaming cheap. But honestly, if they can grow at anything like the sort of rate, I think they can for a compound amount of time. I'm talking 10 plus years. I'm not as worried as some are about the level of, again, doesn't mean they can't fall, but I'm a long-term investor, right? It's not nice when they fall in the short term, but if I double my money in 5 years' time, if I've got to lose 20% at some point on the way through, so be it. I better that than miss out altogether because I'm trying to avoid a loss.
Alrighty, question from Hal. Okay, clearly an alias, Hal 9000. G'day, if you are, I hope we're not getting any AI robots asking us questions. We're feeding the machine, maybe, Scott. I don't think so, though. G'day, guys. If you're getting on and looking to smooth out the bumps, I guess that means you're selling your WiseTech shares. What percentage cash should you be holding at present?
Oh, that's a great question. I want to say 0. I want to say don't try and smooth out the bumps. And I want to say that if you are, so you say getting on, right? Let's say you're 65, let's say 70. Actuarially, you'll live for another 15 or 25 years. So I wouldn't want to take too much money off the table. I can't see what you should do, Hal. You're a computer though, so that's okay. I can probably avoid the disclosure rules. I can tell you what you should do. But for someone who's retired in early retirement, you got decades left, probably. And so being too conservative too early, I think, is a mistake, because you miss, I mean, think about 20 years worth of compound gains. I don't know what the 20-year number is on Vanguard. I could probably look it up. Over 30 years, the market's up 13-fold in value. Let's halve that for the fun of it. Let's say 5 times just for fun, right? You may be losing out on a 5-time gain over 20 years because you're trying to smooth things out. So firstly, I wouldn't do it. But that's not the question you asked. You asked, how do you do it, or what do you do? It's a personal question, because smoothing out the bumps depends on how smooth you need them to be. If you need no bumps, 100% cash. I wouldn't do it. I think it's a terrible decision. But if you're saying, I can't sleep at night, I need to know that I know my nest egg is there, I can't be invested at all, then it's 100% cash. And then it's just a personal preference at that point above that. I know it feels like I'm scribbling the answer, but I don't know. The more cash you have, the smoother the bumps. The more cash you have, the lower the returns in all likelihood over the long term. So that's the trade-off you've got to make for yourself. Trying to think of a clever way to phrase it. I think in terms of when you invest for the medium to long term, and hopefully all of our viewers hopefully are long-term investors, you kind of got to cop the volatility, because that's how you get the returns. That's why the market offers better returns than cash, because the volatility scares people away and they want a higher return to compensate for the volatility. So it's kind of, you say, how can I invest in shares without volatility? It's like, well, it's almost a misnomer. If you're going to do it, the way I would suggest is, depending on your needs for cash, your tolerance for risk and volatility, somewhere between 3 and 5 years cash on the sidelines is what I would suggest for most people. If you need that because you don't want to sell shares, if the market drops, again, COVID 38%, and you got to sell to pay for a holiday, all of a sudden you got to sell almost twice as many shares you had to before, because the value's gone down to buggery, right? So you're trying to make up that difference. 3 to 5 years of cash, with the exception that doesn't include dividend payments you will receive. This is not a plug in any sense, I promise you. Motley Fool Everlasting Income is a service I run. I was lucky enough to get to create it and design it. I run it with a couple other great fools that we work with. And that service's very design is to allow enough of a cash buffer that our members can withdraw every single month, what we call a paycheck, right? An amount of money, not having to sell any shares. We fund the cash balance with dividends effectively. And then we smooth out that super about smoothing. We smooth out the withdrawals by saying, I will take a certain amount of money out every single month, knowing there's enough cash in that cash kitty to fund that without having to worry about what share price they're doing. And that's been going now since 2017, Adam, I think. So 8 years in. I'm very pleased to say, no guarantees, no promises. I'm not allowed to, wouldn't do it. It's gone remarkably well over that 8-year period, including during COVID. It's not an ad. My point here is, you don't need capital on the sidelines if you're getting regular income from your investments, in this case, from your shares. So the more income you're getting, the less hard cash you need, unless you're just like, dude, I don't want to see share prices go all over the place. I just can't cope anymore. And in that case, pick a number that makes you comfortable. If you can sleep at night, that's the right number for you.
Very good. Okay, and you avoided the personal advice there. Well done, Scott. Okay, one final question. Any thoughts on Step One Clothing? So, Scott, I don't know if you know this business, but it's an online direct-to-consumer underwear business in Australia. You've done your research here. The founder owns 58%. Great product, bamboo undies, with enthusiastic customers, growing EPS, high return on investment, no debt, PE of 7. For an internet company, that all sounds really good. Do you know the business, Scott?
I do, actually, yeah. It's a bit small for the services I run. It's only a $90 million market cap. I just looked it up. I don't know off the top of my head. It's a bit small for us to look at from that perspective, but I do like what they're doing. I think it's a really smart business. They're charging a premium price, like they're bloody expensive undies. But if you've ever, I don't know how often you talk about undies with other people. I've spoken to a couple of people who wear them and absolutely love them and just rave about them. And so from that perspective, that's a pretty good starting point, I've got to say. Like, I really like that about the business. The challenge probably is the question about scaling from here. What can it do from this point to deliver the sort of returns that you may be looking for in terms of compound growth? See, these businesses tend to kind of, they rise out of the ashes, just out of obscurity. Great product, great brand, great marketing campaign. Bang, you're there. Okay, great. Now what happens from here? And that's not a criticism, by the way. If I could own a $90 million business on a PE of 7, growing at whatever it's growing at, I'd happily do that. I mean, it's a great little bit, great cash flow business. I'd absolutely do it. The dividend was 14%, if that number's right. I haven't looked at it closely enough recently to have a view on the valuation. A dividend yield of 14% is normally stupidly high and does indicate the market believes that the future is not as bright as the past. So I will give you that caveat. We don't have time for me to really dive into more of the analysis now, but I like the product. The founder's a smart guy. Owns most of the business. I love being aligned with founder CEOs. So this would be absolutely on my short list to look at. I don't know enough, but I'm really sorry. I don't know enough about it to have a strong investment view. As I said, a bit like we talked about PEs before, right? PE of 7, dividend yield of 14. If that's sustainable, that's brilliant. Like, if they can keep doing that, maybe they can. I should look at this after the program. If I get a 14% dividend yield, a PE of 7, I mean, I'm going to make money hand over fist on this investment. I would just say that would suggest the market doesn't believe that the dividend yield is sustainable or the earnings are not going to fall. So just be a little bit careful. But start with the business, which you've done, and I love it. Great business, great product, super loyal customers, evangelical customers. Got a mate who bangs on about them. Founder, CEO, 58% of the company. That, from a quality perspective, that is brilliant. Just look at the growth profile, look at how sustainable the earnings are, and the dividend is. But it's definitely a great place to keep looking.
Yeah, that's a problem. It doesn't matter how loyal your customer is; they're only going to wear one pair of undies at a time, aren't
exactly.
they?
Yep.
Oh, well, that's all we've got time for. Thanks for joining us. Thanks, Scott, again for all of your wisdom, and we will see you all next time. Full on.
Forward to it. Full on.